The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
And a sell-off into the close here, live from Studio 2 at Bloomberg World Headquarters in New York. I'm Alex Steele.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Going to be a momentous last hour of trading.
Oh, momentous indeed. Volume is light, but the price action's anything but. You're looking at the S&P off by over 3%, just continuing to slide to the downside, led in part by tech. So what do? You go to the safety a little bit against at the front end, but that sell-off in the back end continuing. You're looking at that spread, the 210s, the steepest since 2022. Bloomberg Dollar Index, 3-year low. Gold, yet another record high, Scarlett.
All right, the Sell America trade really showing up in a big way. U.S. stocks, longer dated treasuries, and the dollar all feeling the heat, with the Bloomberg Dollar Index at one point falling to a 15-month low. Havens are now limited to shorter dated treasuries, gold, which set yet another record, and the Swissy climbing more than 1% to its strongest versus the dollar in 13 and a half years. Now, at the center of it all is President Trump, who is waging a pressure campaign on Federal Reserve Chair Jay Powell. Trump sounded off on social media, saying there is virtually no inflation, at least in food and energy, and that the U.S. economy may slow if Powell doesn't preemptively cut borrowing costs. There are also multiple reports that Trump is looking into forcibly removing Powell before the end of his term. And then you've got the ongoing trade war. Trump says he'll meet with Walmart and Target executives to calm tariff anxieties, while a new note from Goldman Sachs predicts China's economy will likely slow sharply this quarter because of U.S. tariffs. Beijing is digging in as well, warning trading partners against striking deals with the U.S. that could harm Beijing's interests. Now, Scott Lincecum of Cato Institute says the back and forth between China and the U.S. could be a long-term irritant.
Trade deals typically take around a year and a half to complete. It still seems that both sides are not ready to get down to talking.
All right, so long-term risk that needs to be priced in and is increasingly being priced in.
Right, and I guess the question is, where is it priced in? You can see it pretty much all across U.S. assets, whether it's the long end of the Treasury market, the dollar, or U.S. stocks. This is obviously the S&P, but I want to draw your attention to this. It's the correlation of the Bloomberg Dollar Index versus the S&P. Now, if it goes into negative territory, they're moving inversely, right? Stocks up, dollar down, stocks down, dollar up. What we've seen recently, though, is increasing positive correlation. Now, we get to 1, and it's really correlated. We're clearly nowhere near there. But the idea is, as the dollar sells off, so do equities. And is that sort of a push into selling the majority of U.S. assets, particularly if you look then and you add in the long end of the curve? And Scarlett raises the question, where does the buck stop? Where do equities stop? How do we find this bottom?
Well said. All right, let's kick things off right now with Zachary Griffiths. He is head of U.S. investment grade and macro strategy at Creditsights. Zachary, welcome to the program. Let's pick up right where Alex left off. Where does the buck stop? Where do stocks and which asset class is leading the way here? It's kind of hard to separate the different asset classes, but what's seeing the most pressure at this moment?
Yeah, thanks, Scarlett. There's been a big shift, and correlations and betas seem to be evolving on a daily basis. To us, it seems like you're seeing investors move out of U.S. assets, and so that would be selling equities, and that's hurting the dollar. And that's something that we're really concerned about. When we look at the bond market, I think the biggest thing to focus on is the big steepening of the curve that we're seeing today. When you think about the pressure on the Fed, what does it mean for a market reaction if he were ultimately removed? I think you're seeing a small portion of that today, with equities down, the front end yields lower, and back end selling off.
I mean, so I hate to ask the question, but how steep can we go, right? Like, how much can yields rise on the back end?
It's a great question, and it's tough because our base case is that the curve finishes the year flatter than where we are today, and we're really focused more on the idea that inflation is going to remain sticky. Tariffs are not a one-time price level adjustment. You're going to see sustained inflationary impacts of the proposals from the Trump administration, and that leaves the Fed unable to cut as much as the market is currently priced for. Now, if we're wrong and Fed chair is ultimately removed, I think you could see the curve steepen another 50 to 100 basis points, no problem. If you go back and look at historical norms, the curve has been very flat recently relative to historical norms, especially considering where the budget deficit is today.
So the White House would say that they're focusing on moving forward with the rest of their pro-growth agenda, whether it's tax cuts, whether it's deregulation. How do you see that getting mixed in with the outlook right now of 90% odds, according to Torsten Slok of Apollo, a recession here in the U.S., and this overall concern about U.S. assets being not a great place to be?
It's tough. I think coming into the year, the focus was on deregulation and tax cuts, and that's really what led to market exuberance. We saw that as overdone, whereas the Trump administration and President Trump himself has the most direct influence over tariff policy, and that's what we've seen as the priority. So looking ahead, if we do get deregulation, if we see tax cuts extended and maybe deepened, I think that stems off the worst case scenario from an economic growth or demand perspective, but we could be seeing supply side constraints of tariffs. So it's very difficult to balance. Our base case is a below trend economic growth environment in the US this year.
So what does this mean then, say, for the credit market? The narrative is that the credit market was holding in on a relative basis versus other assets. Obviously, spreads have widened, but still nonetheless. Does that stress, though, really start to appear?
It's tough, Alex, when you think about where we are today relative to our base case. So our calls coming into this year were 110 basis points on IG and 350 on high yield in terms of our year-end 2025 targets. We're essentially there in IG, and we're still a little bit wide of that in high yield. When we think about what's going to drive markets in the second half of this year, it's going to ultimately come down to, are we in a recession or not? If not, we think spreads could probably widen from these levels, but there's a soft ceiling on spreads because there still is a lot of cash in the system looking to get put to work. And when we think about what drives demand really over the past year and some of the conversations we've had with clients is elevated yield levels. And so we think of that as spreads getting bought back down as long as we don't get into this recessionary or even slower growth environment than what we're anticipating for this year.
What are the conversations like with your clients right now in terms of how willing are they to go out on the risk curve? What's their thought process in terms of investing for the rest of the year?
Risk appetite certainly has come down a fair bit, and I think positioning a little bit more defensively, whether that be moving up in quality or shorter in duration, certainly resonates with clients today. But at the end of the day, our clients need to stay invested. And so picking your spots is really important. We had identified several sectors coming into this year, financials, capital goods, in terms of the investment grade market as a decent place to be, as those sectors typically have exhibited defensive characteristics. Overall, I think the receptivity to remaining defensive holds, but the idea that yields remain attractive and could remain attractive for the remainder of this year keeps people a little bit more optimistic than all of the volatility might suggest.
I gotta say, Zachary, though, it's really hard to understand what is safety right now and what is defensive.
Yeah, even as we were going through the assessment of tariffs and what sectors are most at risk, what could outperform, and even looking at the spread moves that we've seen since Liberation Day, since peak volatility on April 9th, it's hard to come up with a cohesive strategy. And so to us, from a broad global fixed income perspective coming into this year, we had a defensive positioning recommendation across the globe. We think that kind of looks like moving closer into cash and maybe within the U.S. overweighting mortgages relative to credit. That's typically been a good play when you expect credit spreads to widen, especially from an excess returns perspective historically.
Yeah, and if you're in cash, maybe not the U.S. currency as well. Zachary, before we let you go, what's the next pain point for risk assets?
The big thing we're focused on is the Treasury's X date and how the debt ceiling negotiations could get lumped into tax cuts and longer term plans in terms of budget reconciliation. And so I think all the focus has been on trade policy. We don't have a tax deal yet. And if we see more brinksmanship trying to tie in the debt ceiling to those negotiations, I think you have an additional overhang of volatility that could persist into the end of the summer of this year. And so we think that volatility remains elevated. We think the Fed's hands are tied, and that's kind of a difficult backdrop for assets broadly.
All right, Zachary Griffiths, a really pleasure speaking with you today. Zachary is head of U.S. investment grade and macro strategy at Creditsights. Now, coming up on The Close, a look at technicals in today's stock market action with Todd Sohn. He is senior ETF and technical strategist at Strategas.
All right, plus a look at financials after the big banks kicked off a busy earnings season with Michaud, a CEO of KBW, a Stifel company.
And speaking of earnings, we're going to look ahead to some of the biggest names in tech with Tesla due out tomorrow. Sarah Kunst, managing director at Cleo Capital, tells us what she'll be on the lookout for with those results. We've got all that and more coming up. This is The Close on Bloomberg.
All right, the S&P is down over 3%. We are around the lows of the session here as we're about 40 minutes away from the closing bell. Todd Sohn is senior ETF and technical strategist at Strategas Securities. Todd, do we get back to testing that intraday low of like 48.53?
Yeah, historically, I would say more often than not, you do retests, right? 3 out of 4 corrections you retest. Most recently, 2018 and 2020 did not have that retest scenario. So I think that's kind of fresh on investors' minds. But what we're looking for on the retest, let's assume it does happen the way things are going right now, is what do volumes look like? Is it less intense than it was a few weeks ago? And how many stocks are making new lows? Because indices, especially when you have super concentration like we do today, mask what's going on, right? So it masks weakness on the way up. Can it mask improvement now on the retest? That's going to be very important. If you do not get less intensity, more improvement under the surface, that's going to be troublesome, I think, for the longer term.
How much do you read into today's sell-off? Because we still have a lot of overseas markets closed. There are a lot of people not in the market
Volume
today.
super late,
Because of the Easter holidays. So we know that that's exaggerating some of the moves.
Yeah, I think what was interesting to us is that the average bear market rally, right? And I think we're in a bear market. I think, well, by all means measured, right? We didn't hit 20%, but let's just consider a bear market. Was about 15% over 30 trading days. We basically hit that in one day the other week. And so now you're just getting that kind of reverb retests now. And so I don't love how there's very distributive price action today, but it's just part of the painful process here. And you're seeing a lot of tactical folks go very defensive in the near term.
The longer that we're below that 200-day moving average, how much more damage then can be done on the downside?
So if you think about trend systems, right, we're in a downtrend. We've had the 50-day cross below the 200-day. That's a warning shot. And what's interesting, when you get a 50-day cross below a 200-day moving average, where we are now, the forward returns in the near term are messy. Right? You can get a 2000, 2008 type scenario where things continue to decline. We're going to rely on credit for that, which we'll see how that evolves. But 1 year out from this type of scenario, you actually get pretty decent forward returns. And so it almost makes you wonder if we're closer to the end than the beginning of this correction. But the key is going to be how much does the economy get affected by whatever's going on out there? What does the credit backdrop look like? Because that's when it turns into a secular bear market like the tech bubble and like the financial crisis. Those are the extremes.
And these are unanswerable questions because we don't know what's going to happen. When you look at the different sectors, and we've seen some of the more defensive sectors perform a little bit better in that they're not falling as much, right? Whether it's healthcare, whether it's consumer staples. How do they look technically, some of those defensive sectors that everyone tends to flock to?
Yeah, staples haven't worked in ages, and now they finally are, because if you had to have that extra exposure, you're going to want to go super defensive. I think it's interesting that utilities are the only sector that have seen ETF inflows since the market peak, and it's much more defensive utilities. It's not the Constellation Energy, the Vistras that were more AI and nuclear thematic plays. It's the Con Edison, the ones that you need actual electricity for. And then healthcare, we can't quite put our finger on healthcare. Healthcare has been so bad for so long. It's had a mass exodus in terms of ETF outflows, but it's struggling because it's so diverse. Managed care doesn't work, biotech doesn't work, equipment has some signs of life, so I like that area. But in the near term, you go strictly defensive to consumer staples. The rally is a little extreme for my liking there, but it can persist in really bad environments.
Let's talk about extreme for their liking. The dollar, Bloomberg Dollar Index, right? It's down to a 3-year low. Where's the bottom? Technically.
Dollar super oversold.
Yep.
You're going to mean revert just because of trading mechanics. But there's just no trend there for us. There's a meaningful dollar unwind going on. Whatever that reason is, we can make up all sorts of reasons. I think you can get a dollar bounce, but I'm more paying attention to what dollar yen is doing. That's really risk off. You have 140 on yen. That's a meaningful change from the last 10 years, right? And then dollar won also trying to test new highs there too. And I think that's more reflective of geopolitical tensions as well.
What are you seeing in ETF flows in regards to the idea that for so long people were trained to buy on the dip, and that was happening throughout the downdraft, but probably less so this past week?
Right. So there's 2 items I have in my mind now. Right. There's always a passive drip into low-cost index funds. That's always there. What I cannot square on my mind is the massive amount of volume and flows going to levered long ETFs. Right. Investors, specifically perhaps retailers, so conditioned to a Fed put, a presidential put, whatever it might be, to buy the dip. And yet it's not really working just yet. So that's a strange corner. On the other side, in terms of tactical flows, you're seeing a massive amount of money go to Treasury bill ETFs. That is basically the only thing that's safe right now outside of, say, utilities and staples. But we know that they can get caught up in volatility as well. So a ton of money going to Treasury bills and a lot of money going to gold, too. For some reason, gold flows were agnostic for a while. and then it hit a 5,000-year high, whatever it might be, and all of a sudden everyone woke up and said, oh, we got to buy gold. So I don't love how gold's going parabolic here in terms of flows and trend.
I was going to say, how overbought is gold right now?
You're getting super extreme, historically extreme. So I'd be a little bit careful buying new allocations to gold right now.
All right, Todd, always a pleasure. Thank you so much. Todd Sohn is Senior ETF and Technical Strategist at Strategas Securities. Coming up on the close, is there any magic left in the kingdom? Wolfe Research says yes. Up next, we're going to speak with Peter Supino about his decision to upgrade Disney to an outperform rating. This is the close on Bloomberg. It's time now for our top calls. We'll look at some of the big movers on the back of analyst recommendations. And we're going to start with Tesla. Wedbush maintaining its outperform rating and price target of $315. But analyst Dan Ives says the EV maker faces a code red moment before Tesla's earnings tomorrow. Though Ives remains bullish on Tesla, he says he believes Elon Musk should step back from his work at Doge to focus on the company. Shares down almost 7%.
Really looking forward to that call tomorrow. All right, up next, Amazon. Raymond James downgrading the big tech giant to outperform from strong buy and slashing their price target to a street low of $195, down from $275. And the move comes ahead of Amazon's upcoming earnings report, which the analyst believes will be impacted by the U.S. trade war and the company's continued investments. Shares are down almost 4%.
And last up is Disney. Wolfe Research upgrading the stock to outperform from pure perform, setting a price target of $112. The firm says the media giant's cruise expansions and password sharing crackdowns are helping Disney de-risk downside in the event of a macro downturn. The shares outperforming the market in that it's only down 1.4%. And those are some of our top calls. Joining us now to discuss is the analyst behind that call, Peter Supino. He is Managing Director and Senior Analyst of Media and Entertainment at Wolfe Research. Peter, good to speak with you. To what extent is Disney unique among the big media companies or entertainment companies in what you say is some resilience here in the event of a macro downturn?
Yeah, what a way to win today with the stock only down 1.5%. Disney's unique in a couple of extremely important ways. A client asked this morning how we value Disney relative to what, and we answered that it's hard to benchmark Disney to any one company because its business is really first and foremost experiences. It's theme parks and cruise ships. And after that, it's the production of film and television and the distribution of that across many different channels, the largest of which is its own distribution channel. And in that way, Disney looks a lot like Netflix. But Disney's price doesn't look very much like Netflix. The stock trades for about 15 times earnings.
So why has it traded so poorly, Peter?
Well, Disney's got some real problems. We've had a neutral rating on Disney for the last 2 years. And part of the reason has been that the monoculture is under attack. Children and young people and young families their attention is competed for by a dynamic and rapidly changing, supply side of the media industry. Disney used to have a much less competitive stage. The other reason, of course, is streaming is a very, very competitive business, and Disney doesn't make any money in streaming right now. They have about $23 billion of direct-to-consumer streaming revenue, but that contributes just barely any profit.
You mentioned in your note that cruise expansion is something that can help it de-risk downside. Where else should Disney, or do you think Disney is best positioned to kind of keep investing in its business rather than, kind of being really mindful of costs and perhaps even cutting expenses?
Yes, that is exactly the right way to ask the question. Disney has been under the leadership of Hugh Johnston, who became CFO less than 2 years ago. Disney has been extremely focused on efficiency, and it needed to be because the media segment at Disney was barely profitable, and the streaming business was hemorrhaging cash. And your question was, where is Disney investing in expansion in the future? And the answer is in plenty of places. So first and foremost, that DTC, that streaming business, by virtue of being a $23 billion revenue business with a break-even profit margin, it means they're spending $23 billion against that streaming opportunity. And there are very few businesses on earth with that much revenue and expense that don't make money. And so we think there's plenty of investment in the future in that streaming P&L. And then the cruise ships. Disney is launching 3 new cruise ships over the next 2 years, which we think will generate $800 million of incremental profit, not just revenue. And in doing so, ensure that there's growth in that experiences business while the economy is shaky.
But at the same time, Peter, then you take a look at their parks business, and didn't they lower the price for its theme parks, which was like a never-before-seen moment when it comes to its theme park in Florida? So what's our read-through then on the consumer as it relates to Disney?
The biggest risk in this upgrade is clearly the risk of being early, and maybe we are. We've been trying to start the conversation about Disney at $83 a share with clients based on the assumption that the country is heading into a recession, but also based on our forecast that the earnings this company would produce if we had a moderately harsh recession for a year would be in the 450 to 470 range. And with the stock in the low 80s and the history of this company having a reasonably market-like multiple, we think that's pretty well priced in. So near-term volatility notwithstanding, we think the range of outcomes is kind of 120 to 140 on the upside over a couple of years, and maybe 70 in a very tough downside scenario.
Peter, lost in all of this is talk of who's going to replace Bob Iger when he finally is done leading Disney. We know James Gorman is the chairman of the board, and he, of course, engineered a successful transition over at Morgan Stanley. How much pressure is the company under to come up with an answer to that?
Well, plenty of pressure. The board of directors is, of course, interviewing outside candidates because that's what large companies do in a moment like this. We think Dana Walden is the lead candidate for the job. She's a well-respected internal candidate. And we probably won't know until at the soonest second half of 25, if not 2026.
All right. Well, obviously, you keep us posted on that. Peter, thanks a lot. Really appreciate it. Peter Supino, Managing Director and Senior Analyst over at Wolfe Research. Bloomberg Intelligence had a really great note out that talked about how discretionary categories like an AT&T or Verizon or Disney might be subject to discretionary spending cuts, but they have the war chest, right? They can manage it.
Yeah, and for some people, it's a staple. Our producer, senior producer, was just at Disney over the weekend or over the last week, and they had to spend, and there are plenty of other families also spending out there.
That's right. And also, Netflix, is that discretionary anymore?
It's a
or
utility.
Is that like you have to spend? It's utility. All right. Next, we're going to speak to the CEO of KBW, his outlook on the banking sector and how the uncertainty caused by tariffs impacts the markets.
It's about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. Taking a look at the market, we're still to the downside here. Volume, though, very light as it's a holiday in most of Europe. But Scarlett, we do have an extremely busy earnings week. It's the second busiest week for earnings. About 24% of companies are reporting from the S&P.
$10.7 trillion worth of market cap, and it's kind of the lead up to the big one, which will be the following week, where almost $20 trillion worth of companies will be reporting results. But we do get more of the big tech names coming up. Alphabet of the Mag 7 will be reporting, as well as Tesla. Tesla will be super interesting.
Yes,
because,
so many layers there.
Yeah, Elon Musk just kind of looms over everything.
Yep, and we get some airlines, as you were mentioning. Also, we get some industrial companies. And last week, of course, we got some of the big banks. And then we get the regional banks. And the difference is sort of how the regional banks will address the uncertainty and what they're seeing from their customers and consumers as well. Well, joining us now to discuss is Tom Michaud. He's CEO of KBW, a Stifel company. Tom, good to see you.
Good to see you as well.
Help us make the transition from the big banks to then the regionals, right? Big banks are going to be more exposed to capital markets versus, say, the regionals, right?
Absolutely. And so far, the story has been somewhat as expected. So investment banking has been weak due to the fact that the turmoil and the volatility in the markets has pushed a lot of M&A activity and capital markets activity out onto the horizon. But the core business of banking has actually been very good. Mainly, we think, in the area of deposit cost control. So deposits have been very steady and have been coming in a little bit better for banks. And so that's been improving the net interest margin, which really is the core business in banking. And then credit has been extraordinarily benign, which I say what's surprising is not that it's going to go up one day, but for how long it's been benign. So still another great quarter in terms of credit. And then trading has been very good for Wall Street. And that's been a big part of the story.
So I want to ask you about deposits. What's driving the increase in deposits? Is it the market volatility? Is it the idea that rates are going up, so people are putting money in there? It's the lack of loan demand, which is a whole nother story, getting to where things are today. So the economy was slowing before Liberation Day. So remember, the Fed had raised rates to slow the economy, so it was working, right? Now we were in cutting rate mode, and so they were getting ready to cut again because the economy was slowing, and that's what the market had been looking for. So sure enough, the first quarter was a very slow quarter for loan growth. We expected slow, and it ended up being even slower than we expected. So I think that says something about what's happening in the economy.
Wouldn't this then all be bad for regionals that don't have exposure to capital markets in the same way and are dependent on loan growth?
Well, our earnings are still, so the good news on the longer term picture is that the yield curve is no longer inverted. So banks can regional banks can operate and work their way around here. So net interest margins are expanding. They'll continue to expand because the yield curve is no longer as adverse as it once was. So the core business of banking is continuing to grow as long as credit remains under control. If we get a shift in the credit outlook, that can change the earnings profile quickly. But right now, we're still calling for earnings per share growth for this year for the banks. And remember, they're not the first derivative of tariffs. What happens in the economy certainly drives what happens for them, but they're not big importers or exporters.
Right, they're not directly impacted
Correct,
by tariffs.
But the economy matters, of course, a lot.
Certainly. So how do they position themselves in this defensive environment, in this, environment where people are sitting on their hands, whether it's consumers or companies?
You know what? I've been listening to some of the conference calls, and they're on offense. And, look, they've been under attack by non-banks. And what's interesting, if you look at the non-banks today, they're down over 5%. You think of companies like KKR and some of the bigger alternative lenders. There are a lot of moving parts because this will be the first real cycle for them possibly since they've gained so much market share in the private credit market. I mean, these are very good companies. I'm not saying they're not, but banks had kind of been on defense in this inverted yield curve world. Now they're actually flush with cash. They've got room to lend. They stand ready. And as long as we don't have a hard landing, that's what I'm really saying. We have a soft landing. Everything will be pretty good in the banking industry. We have a hard landing. Let's get together and talk about that again. But it's a chance for them to take some market share back from the non-banks because of the strong position, and their capital hasn't been better in dozens of years.
So 2 weeks ago, we had that yippee, quote unquote, trading in the Treasury market, right? And some of the conversation was, look, if you roll back some of the supplemental leverage ratio for the big banks, where they can more freely add treasuries to their books, that would really help smooth the system out. Do you think that's going to happen?
I do think it's going to happen. I think that this is one of the quiet surprises. So much talk about tariffs, and now the Fed is in the conversation. What's happening in the background is we've seen some real movement. And I don't want to say deregulate, because personally I think we were over-regulating. How about if we just pivot and recalibrate back to what had historically been the case? You've been seeing it happen in some of the rulemaking. Even if you look at some of the speed at which the regulators have been responding to applications, things that took as long as a year and a half in the prior administration are happening in a matter of months with bank applications with this group. So I think it's very good for business. It's good for the economy to see that happening. So yes, I think the immediate reaction after the Silicon Bank failure and others was more capital, more regulation, more rules. And the reality is that had nothing to do with those bank failures. So now that's going to be rolled back. Of course, what we do need is deposit insurance reform, which is something that I've been really, it's been important to me because I think it's important to the economy.
How do you see that shaping up? What's needed on that front?
So what you don't want to have happen in times of crisis is have small businesses choose their bank based upon its size, because there's an implicit guarantee that big banks are too big to fail. So what you would like to see is that operating accounts, payroll accounts. Let's flash back to that period of time. We were reading in all the news sources that small business was worried they couldn't make their payroll because they had their account at Silicon Valley Bank. And so for safety purposes, they'd want to go to a big bank. You have to correct it. All the reasons why the FDIC was created in the 1930s are the reasons why we need to grow with the economy, need to modernize it. We need to raise the limits so small businesses can feel comfortable keeping their payroll and operating accounts with a regional bank.
So you've been pushing for that.
I have.
Do we also wind up seeing M&A in the banking sector, which also should have been the trigger after Silicon Valley Bank?
So my firm advised on 4 bank mergers just a couple of weeks ago in 1 week, which is and that was after Liberation Day, so it was a pretty strong clip. We got approval at the end of last week for the Discover Capital One merger, which I think is good for the industry, good for the economy that's happened. And I do think we will continue to see consolidation as long as we don't have a hard landing. If we have a hard landing, I think that changes things. But the reality is scale has been working in the financial services industry. So the power of scale, the power to afford a lot of the technology investments favor consolidation. So I think you will continue to see more consolidation. And by the way, I don't think we should measure the success of the banking industry by how many banks we have. We should measure it by how capable the banks are that we have. And really what the industry needs, instead of having 4 really big banks that control 40% of the deposits, they need competitors. Better to have competitors build to challenge the big banks. And I think that's a good reason for consolidation.
And then perhaps the services are better for everyone involved then.
Yeah, and also, too, to the fact that if we see consolidation during this period of what's going on, I think it's a bullish statement about the health of the industry.
All right, Tom Michaud, CEO of KBW, which is a Stifel company. Thank you so much.
Thank you.
All right, coming up on the close, we're going to talk about Tesla. The shares are shifting into reverse after the Tesla bull analyst, Dan Ives, said the company is in a code red moment ahead of its earnings tomorrow. We'll take a closer look. It is our stock of the hour next. This is The Close. All right, Tesla shares down right now in trading. You can see losing about 6.5% before the company reports earnings tomorrow. This after Tesla bull analyst Dan Ives of Wedbush renewed questions over Elon Musk's role at Doge. He says Musk needs to take a major step back on Doge and get back to being CEO of Tesla full time. Joining us now to discuss is Dana Hall, who covers all things Tesla and Elon Musk over at Bloomberg. She joins us from San Francisco. Dana, Elon Musk is a constant presence during Tesla's earnings calls. What has his involvement been since he started working at Doge? I mean, how intimately tied to the operations at Tesla has he been?
Well, frankly, not a lot. I mean, he has been in Washington, D.C. for much of the time since inauguration. His jet appears to be in the Bay Area now, but, he has been very focused on his project of remaking the American government. And I think for Tesla shareholders and employees, the big question is, when does Musk step back from Doge, and does he come back to Tesla full-time or not? I mean, he's always had other companies, SpaceX chief among them. And so the challenge with the company is that Musk is so intertwined with Tesla that they can't live with him, they can't live without him. His work with the government has really impacted Tesla sales and the brand. And, Ives, who has been a longtime bull and is still bullish, is like sounding the alarm bell, on Easter Sunday that this is a big red code moment. And I hope that sell-side analysts actually ask Musk about his time with Doge and when it's coming to an end.
So, okay, let's just pretend for a second that on the call, he's like, yep, coming back, leaving Doge, etc. What's the premium that commands on the stock? Because some of the issues with Tesla were fundamental and were there before he even went to D.C.
For sure. I mean, I would imagine that the stock, I'm not a prognosticator.
Sure.
I would imagine that the stock would react positively because it's he is just such a unique CEO, right? There's no one else in the United States who runs not just one, not just two, but basically 5 companies and is a special advisor to the president. It's just sort of unheard of for someone to have that kind of range of activities. And for Tesla shareholders, we've been through this before. They were very upset when he bought Twitter and renamed it X. Similarly, they are very upset that he is focusing on the government. And you're really seeing the backlash of all of everything in Musk's empire. It's hitting Tesla the worst. Shares are down more than 40% since inauguration. First quarter sales were terrible. What does the company do to regain growth and to kind of sell investors on this idea that the future is all about autonomy and AI and the robotaxi?
You said something very interesting, Dana, while Alex gets a drink of water. You said you hope that analysts will ask Elon Musk about when he'll leave the government to return to Tesla. That suggests that they don't press him on anything, much of anything. So that being the case, is there going to be anyone talking about the fact that sales of Teslas have really gone down since his involvement in the U.S. government? And this is not just domestic sales, but sales overseas as well.
Right. I don't know if you've listened to a Tesla earnings call recently. In my personal opinion, I don't think that the analysts do a great job of asking very pointed questions and follow-ups. They tend to talk about, that's why it'll be interesting tomorrow to see what the tone is. Musk could surprise us, and he could come right out of the gate with some prepared remarks that say, I'm a special government employee and I'm leaving the administration as of, May 30th or whatever the date may be. That would be very surprising. But yeah, I hope that people take the opportunity to really press him on his time in government.
It's going to be fascinating. Cannot wait to listen to that. Dana, thanks so much, Dana Hull of Bloomberg, joining us on what to expect from Tesla after the closing bell tomorrow. Coming up, we're taking you to today's closing bell with Ellen Lee, portfolio manager at Causeway Capital Management. This is Bloomberg.
But our base case is that the curve finishes the year flatter than where we are today, and we're really focused more on the idea that inflation is going to remain sticky. Tariffs are not a one-time price level adjustment. You're going to see sustained inflationary impacts of the proposals from the Trump administration, and that leaves the Fed unable to cut as much as the market is currently priced for. Now, if we're wrong and Fed chair is ultimately removed, I think you could see the curve steepen another 50 to 100 basis points, no problem.
That was Zachary Griffiths, head of U.S. investment grade and macro strategy at Creditsights, kicking off the show and really wrapping together all the themes that are driving some of the market action today, which is clearly to the downside for risk assets.
To the downside, but now off the lows of the session as we head into the closes in the last about half hour of trading, and volume is also quite light, but nonetheless, you kind of see red everywhere you see it. Obviously, we're led here by big tech, but Scarlett, it's not just big tech, it's also the transportation index too. Look at the Dow Jones transportation average, right? Down over 2% as well. So it's a relatively widespread sell-off.
All right. So when you look at that screen, lots of red here. One thing to keep in mind, of course, is that we don't have full volume. It is a holiday in many parts of the world right now because of Easter Monday for a lot of people. So we'll see how things shake out for tomorrow. But in the meantime, let's welcome Ellen Lee. Ellen is portfolio manager at Causeway Capital Management. Ellen, how do you read today's decline or today's sell-off? Is this just kind of a low volume event, or is this indicative of a new wave, a new round of concern for investors?
Things are changing by the minute, in the current market condition. I think it's just the voting mechanism in the market saying there is just less confidence around U.S. assets, and people are seeking to either diversify out of U.S. or seek other havens because the uncertainty and the non-visibility is making people be very fearful.
I was talking to another portfolio manager today, and she mentioned that she wants to invest in companies that are resilient cockroaches, where they're going to get growth, they're going to get earnings, but they're not that exciting. And I love that image, Ellen. And I wonder, is the U.S. the place where you can still find that?
I think, of course, I think there are companies that are better positioned to figure out how to move forward. I think in the current market environment, there are a lot of dislocations happening. So active managers like us at Causeway, global equity manager, as we are trying to find those idiosyncratic opportunities. But the backdrop is very challenging. But, the company-specific work that we do to find those high-quality, better growth ideas will prevail. I don't think it's completely uninvestable if that's what you're asking, but it is a challenging environment for sure. Because there's always winners and losers.
Yes, absolutely. And we see that day in and day out. But is it more investable outside of the United States to go look at Asian markets, to go look at European markets, for instance? We've seen those hold up better as kind of a knee-jerk reaction, but are the fundamentals better there too?
I think there are a couple things that I could point out, from a macro perspective, just the relative certainty that exists, or a relative less uncertainty that, you can see in Europe or Asia could make people feel more excited about, moving money out of the U.S. Secondly, valuation support definitely is there for international markets, because the margin of safety from a valuation perspective is there. And also, if you think about, potentially tailwinds being created because these countries now will have to invest and pay more for their defense, and therefore that will provide investment opportunities which will not exist in the U.S.
Okay, so yeah, it's going to be one of your top picks, Ellen, outside of the U.S.
So the stock that, I want to share with you today is Deutsche Bank. It sounds scary, investing in a bank. However, first of all, valuation very compelling. Secondly, they've really fixed their returns from a, return perspective. And thirdly, they're exiting out of a penalty fine situation. They just need to follow the playbook of a lot of European banks that have been successful, like the UniCredit and also some of the Spanish banks. So we think the backdrop is more favorable. And again, the fiscal situation is way better there than here.
Yeah, Deutsche Bank shares up about 24% in euro terms so far this year. And banks, in fact, up 14% for the best performance in the stock 600 so far this year. Ellen, you are responsible for investment research in the global consumer sector. All global consumer companies are affected by the tariffs that President Trump is imposing or threatens to impose. What kinds of companies, based on management, do better, fare better in this kind of uncertain environment? What do you look for in the management teams?
Management teams that are using conservative estimates and also managing the balance sheet conservatively. And also in this time, I think definitely having more diversified footprint in terms of their global presence will be good. Because right now, if you are too heavily weighted in the U.S., a lot of management are concerned that they have concentration risk. So the companies that could do well are maybe, companies like Anheuser-Busch, has significant operations in the U.S., but also globally diversified where they can benefit, if other markets outperform the U.S.
Ellen, if you haven't sold yet in terms of U.S. stocks, is it too late?
Oh, that's a tough question. I think, we don't really make calls based on geographies. I would look at company specifics, but there are U.S. stocks that we're currently buying. So I wouldn't say we would do indiscriminate selling of all of U.S.
Ooh, okay. Ellen, what do you anticipate, what do you most want to hear from the companies when they are reporting earnings this earnings season?
I think I would like for the companies to be able to have, pricing power. For companies that have pricing power, they will prevail because it is also, going to be an inflationary environment. So the companies that have that will be able to maintain their earnings. The other aspect of it is also companies that are able to diversify into different markets and different opportunities, have a price ladder of products where they can sell to different kind of consumers and different kind of environments.
All right, Ellen, thanks a lot. We really appreciate you. Ellen Lee, portfolio manager at Causeway Capital Management. Great roundup there of market picks. All right, taking a look at the S&P, we are off by 2.36%. So we are off the lows of the session, Scarlett, but volume is quite light. But talking about earnings season, 24% of S&P companies are going to be reporting this week. It's going to be a big one. And we have a real variety of, right? It's not just big banks. It's a little bit of Netflix. You got Tesla. You have some industrials. It'll be really interesting.
Yeah, Tesla and Alphabet are the big ones from the Mag 7 that will be reporting this week. But General Electric, Lockheed Lockheed Martin as well. So the industrial side of the economy is also going to show up in a big way.
Gina Martin Adams of Bloomberg Intelligence was telling me that 65% of companies that have reported missed on sales. And that's extreme. And you have to see if that actually filters out as we continue through earnings season.
If they're giving any kind of outlook, it's probably not very robust
like
either.
A fan outlook at the end of the day, right? Like it might be this, it may be that. All right, 10 seconds away, or I should say 2 minutes away from the closing bell right here in the U.S. We got you covered, full market coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, I'm Alex Steele, and alongside Scarlett Fu, we're going to take you through the closing bell in a global simulcast. We're joined now by Carol Masser and Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. Guys, I haven't been on air for about 5 whole days, 5 whole trading days,
Welcome
and
back.
It feels like it's the same deal. We're just selling here, selling, right?
You're welcome. You're welcome.
You.
We had some updates last week, though, at the beginning of the week.
Long forgotten right now.
Yeah, but it's like, no, we're just going to still stay into the selling mode. Yeah.
I will say, interesting to see some buying into the close. We talked earlier with our Eric Weiner, though. He said that volume was kind of low here. But nonetheless, to see in the last few minutes of trading that there are some investors finding some opportunities, even though broad-based selling and a lot of names are down. I think that's a little bit of a positive sign, but little one.
Okay, all-time high for gold. We knew that. Have you guys seen what Bitcoin is doing? This is a little wild. Bitcoin's at its highest going back to the end of March. It's up another $2,200 today. The moves counter to what's happening in other risk assets today.
Yeah, well, short-term treasuries are also up, and short highly rated credit is also up. So those are your havens today.
You know, it's down the dollar. We're at a 3-year low when it comes to the dollar. It still feels like it's sell equities, sell the dollar, sell the long end of the curve. So it's still that sort of push to selling U.S. assets. And I just wonder kind of how much that theme has to go.
Yeah, exactly, right? That's what we're trying to figure out. Where do we bottom out? And you keep thinking maybe earnings are going to help us. But we talked with our Gina Martin Adams, and it feels like people continue to, reduce those earnings estimates for this year as well as into next year.
Ooh, great timing, guys. There is a closing bell on this Monday. You're looking at S&P closing off about 124 points. That's about 2.3% off the low. So a little bit of buying into the closing bell. The Dow Jones Industrial Average, guys, off by about 2.5%, and the NASDAQ off by 2.5% as well. That was the big underperformer, guys, but it feels like now we're pretty much on par. And I'm just taking a look at the Russell, the small caps closing right in line. 2.1%, Carol.
All right, and as we've been saying, broad-based selling, though, on this Monday. So if I look at the S&P 500, roughly 463 names to the downside, and you've got about 39 holding on to some gains here.
All right, let's take a look at the IMAP. Pretty simple today. There's no cheese, there's no pesto. It's just all red sauce and maybe some pepperonis in there. Everything is down across the board. 11 sectors all in the red. Even when you slice it into 24 industry groups, Carol, all 24 groups are falling as well. The better performing groups, food, beverage, and tobacco, consumer durables, and apparel. So that gives you a sense of where some of the safer places to hide might be.
It's like a super bad sunburn. That's what it looks like. All right, let's get to some of the individual gainers. Cross my fingers that they're holding on to it. Netflix, up as much as 4.7% today, closing with about a 1.5% gain. This is a top gainer in the NASDAQ 100, saw it higher too in the S&P earlier. Some momentum. I forgot, like earnings on Thursday before the long weekend. It feels like a lifetime ago. We did get that. The company did come out and it did forecast revenue for the second quarter that beat the average analyst estimate. And analysts are seeing the company's business as resilient amid a tougher macro environment. So the expectation is that, maybe Netflix is one of those things that you don't
Well,
really
here's my
cancel.
question, Carol.
Yeah.
Is Netflix discretionary anymore?
Well, exactly. I mean, there's been a lot of research, right, where folks are saying, or, that maybe it is, you got to have this. Like, it's a cheap
it's a utility.
luxury, right?
If you cut the cord, then you probably have Netflix.
That's what I'm saying. Like, there's no way that I would let that go. I would let go other apps before Netflix. Anyway, I digress.
All right, consumer staple then. All right, Discover Financial, number one gainer in the S&P 500, up about 3.5%. It was up more than 7% during its highs today, but still holding on to about a 3.6% gain. Capital One receiving receiving approval on Friday from U.S. regulators to buy Discover. And this creates the nation's biggest credit card issuer by loan volume. Capital One, we also saw trade higher in today's session. Analysts kind of weighing in. They say maybe we could see some more consolidation. And they do say the deal creates significant value for shareholders. So that's a pop here in today's session. And Fidelity National Information Services, FIS is the ticker. This went up about 2.4%. This is your number 3 gainer in the S&P 500. Payment services company raised to buy at both Citi and TD Cowen following recent deals with Global Payments, sale of a stake in WorldPay, and purchase of an issuer solutions business, making the company's business model steadier. That's according to TD Cowen. So some decent gainers in today's session.
Some decent decliners in today's session is another way to put it.
Embarrassment of riches for you.
It really is. I mean, look at Tesla right here, down 5.8%. It was down as much as 7.7% earlier in the session. Questions remain over Elon Musk's role within the federal government and uncertainty over the company's plans to introduce a lower cost EV. Dan Ives over at Wedbush out with a note over the weekend that said Musk should step back from his government work and focus on Tesla, citing brand damage and a potential 15 to 20% permanent demand destruction. Here's what he wrote. Musk needs to leave the government, take a major step back on Doge, and get back to being CEO of Tesla full time. Tesla is Musk and Musk is Tesla. And anyone that thinks the brand damage Musk has inflicted is not a real thing, spend some time speaking to car buyers in the US, Europe, and Asia. Once again, Dan Ives over at Wedbush out with that note. Shares are down more than 50%, though, from those highs back in December. Moving on to another mega cap name, Amazon. Falling in today's session, down a little over 3%. It was downgraded by Raymond James due to anticipated earnings pressure from increasing investments in U.S. tariff increases on imports from China. Despite the downgrade, 95% of analysts that are tracked by Bloomberg do recommend buying the stock. Some cite attractive valuations relative to its history. And finally, how about one for the folks who go out to lunch? Sweetgreen, down today by 8.2%. It was down as much as close to 12%. This after the company said its COO would leave the company, and separately, B of A cut the target from $36 to $31. Sweetgreen shares are down more than 61% from their highs back in November. So
yeah, that's because $20 salads may not be most people's staples. That's like definitely a cost you can cut.
It's like a Netflix, a full subscription to Netflix for the month in a salad, right?
Yeah, like what would you do? A salad for a day or Netflix? You keep Netflix, you boot the salad, and you eat food at work. Not that I do that. All right, guys, I'm going to the bond market. You're seeing buying in the front end, selling in the back end. This is a very typical situation over the last couple of weeks. That curve steepening. If you look at the 2 in the 30s, this is the steepest curve since January of 2022. And the velocity and the move that we've seen this has been quite staggering. And I just wonder how much more juice there is to go. I mean, the 30 years almost at 5% at this point, guys.
Yeah, it's pretty remarkable to continue to see the steepening of the yield curve here. And, you know, it makes the Fed's job much more complicated as well going forward. Not to think that Jay Powell had it easy at all, given the kinds of things that President Trump is saying about him on social media.
Yeah, listen, I mean, it just is another uncertain, aspect to the overall environment that is full of so much uncertainty right there. And so you just think about what's ultimately the impact, right? We've talked so much about CEOs maybe not spending, CapEx spending, and maybe not hiring, and all these things just ultimately put a damper on the economy. You know, you just kind of think about where this ultimately will go, or could it change in 24, 48 hours, or in 60 days or 90 days? I guess, that's kind of
the next 3 years.
Look, who knows if it's going to change over the next 3 years or 24, 48 hours. What I do know is over the next few days, we are going to hear from a lot of companies, including Tesla tomorrow. That's certainly a big one. We'll hear from Lockheed Martin this week. We'll hear from Boeing on Wednesday. We got Texas Instruments. We got IBM. We got Norfolk Southern. We got Intel on Thursday. We also got Alphabet coming up as well this week. So a lot of questions that I know analysts are going to have about CapEx, hiring, how these companies are looking at tariffs, and hopefully we'll get some answers this week.
I was telling Scarlett that I spoke to Gina Martin-Adams of Bloomberg Intelligence on Bloomberg Radio earlier today, and she said that 65% of companies have missed sales in the first quarter so far. So what does that mean? Is that because the sectors that we got just happened to miss sales? Is that because expectations were just too high anyway, and everyone thought that it was going to be pretty easy to beat any sort of tariff issues, and then we realized that wasn't actually true? Or are we really going to see some earnings season roll over here? And if that's the case, do we need to lower our estimates for earnings for the whole year from 8% to what? ... Question mark.
That's so interesting, given that we know anecdotally so many companies are front-running the tariffs by buying a lot of what they need. I think about, a lot of consumers going out to buy a lot of stuff right now before the tariffs come into effect. If you're still seeing revenue decline, what does that say for when the tariffs are actually in place and people are really holding back on their spending?
I want to go back to what you were saying, Alex, because we talked with Gina too, and that revenues miss was really surprising. And then she also talked about, analysts basically, talking down their numbers, the projections for this year and what they expect from companies. But then she said they're starting to do it into 2026. So, that's a pretty negative sentiment and has to be a little bit worrisome at this point.
At the same time, perhaps we'll start to hear about one-on-one trade deals being reached with different countries. I think certainly the one that has most investors concerned does include China. But maybe we'll start to hear from the president and the folks working on trade policy when it comes to individual countries, and that maybe they've reached deals. So some clarity there, perhaps.
How are we feeling, guys?
It's a Monday.
It's a Monday.
Monday after a shortened week.
Whew, it's a rough one. All right, that's our cross-platform coverage. Radio, TV, YouTube, Bloomberg Original. Scarlett and Alex continuing over there on television. Tim and I are going to continue here on Business Week. We'll see you again, same time, same place tomorrow.
All right, we will rejoin our radio colleagues tomorrow. And of course, Alex is taking off for the day. In the meantime, coming up on the close, a major recessionary call update from Apollo Global Management today. The man behind the call, Torsten Slok, chief economist and partner over at Apollo, will join us next to discuss. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu. We want to show you what happened in markets for the day. It was a lot of red here with the S&P 500 losing 2.4% on the day. This is off its lows, but still a big sell-off here as it wasn't just limited to stocks. You also had longer dated treasuries, the dollar, commodities declining here with the exception of gold. What you are seeing, though, is some relief at the short end of the yield curve. And you can see the yield on the 2-year come down 4 basis points to 3.75%. The 10-year, however, yield moving up by 8 basis points to 4.4%. So a steepening of the yield curve. And the Bloomberg Dollar Index at about a 3-year low right now, with the dollar losing ground against many of the big safe haven currencies like the Japanese yen, like the Swiss franc as well. And of course, this comes as President Trump has rejected Jay Powell's interest rate policy, pressuring him to cut rates, saying inflation is virtually invisible right now, according to his words. Let's also take a look at some of the individual movers on the day. There's a lot of red, so I focused on Amazon and Tesla first and foremost. Amazon downgraded by Raymond James after the firm said Wall Street analysts are underestimating the impact of the U.S. trade war, as well as Amazon's continued investments on its earnings. Tesla is also down about 6%. Wedbush Securities analyst Dan Ives, who remains a bull on the stock, says the car maker is falling into a code red moment as it prepares for its earnings tomorrow. He's referring to the broad damage that Tesla has suffered from Elon Musk's time in government. And Netflix extending its gains. Its post-earnings advance, it's now higher for a fourth time in 5 days. A lot of people talking about this company being more resilient in a recession and how its business holds up better in this tough macro environment. Speaking of tough macro environment, is a U.S. recession almost a certainty at this point? Torsten Slok, the chief economist at Apollo, puts the odds at 90%, warning, quote, implementing extremely high tariffs overnight hurts many businesses. Expect ships to sit offshore, orders to be canceled, and well-run generational retailers to file for bankruptcy. It's a dire picture, and I'm pleased to welcome Torsten right now to the program. Torsten, thanks for joining us. When we talk about a recession and you put the odds at 90%, you're talking about a quote-unquote voluntary trade reset recession. What does that mean exactly, a voluntary reset recession?
So what that means is that there is obviously a need to level the playing field when it comes to trade. The U.S. has been an open economy for time, the U.S. economy has had the lowest level of non-tariff barriers, the lowest levels of tariffs. So on the back of that, the administration is, of course, trying to do what you could call a trade reset. The challenge is that the way these policies are being implemented, it comes, unfortunately, with some pretty significant adjustment costs, especially for small businesses. Because remember, as we all know, when goods arrive from China to Los Angeles, the tariff has to be paid at the port. And the problem is that the tariff has to be paid, of course, before the goods are sold. And that means that large companies, they do have working capital where they can pay for that upfront. But small companies, independent toy stores in the Midwest, if you also look at, for example, clothing companies for, say, men's stores in the Midwest and across the country, and also, say, a company that sells ski gear in Colorado, they do not have working capital. They do not have excess cash to pay 145% extra in terms of tariffs. So the consequence of that is that small businesses, which make up, by the way, 80% of employment and 80% of capex, they will be hit a lot harder as a result of this.
Now, we know President Trump has said some companies will eventually be granted exemptions from the tariffs. And I think back to the first administration when Apple most famously was exempted from a lot of those tariffs. The difference is Apple can make a trip to Capitol Hill and request an audience with the president, whereas those small and medium-sized companies that you're referring to don't have that access. When it comes down to what shows up in the data, if big companies are exempted from tariffs, that's good for profit margins of S&P 500 companies. It certainly limits the damage there. What does it mean when small and medium-sized companies are subject to those tariffs and the destruction shows up in their numbers? Where do we see that in the data, Torsten?
Yeah, this is very important. So let's look at what the size is of the small business sector in the U.S. So there are about 6 million companies in the U.S. with employment. So that's, of course, a lot of companies. And of course, of those, 500 is the S&P 500. But of course, everyone else than the S&P 500. So first of all, again, about 80% of employment is in small businesses. Another important statistic is that 40% of imports from China go to small businesses. So that means that small businesses are using that partly to sell the products, but also as intermediate products. Overall, 40% of imports from China is intermediate inputs into production in U.S. companies. So that's just another way of saying that U.S. and China are very closely connected on so many different fronts that to rip that apart from literally one day to another is going to come with some fairly significant adjustment costs, not only when it comes to consumer goods, but also when it comes to products that are used as intermediate goods in U.S. production. So the answer, Scarlett, to your question is, where should we expect to see this? Well, as you were just talking about, there is some front loading of purchases with expectations of tariffs being, of course, in the pipeline on a number of different products. So there have been significant purchases in retail sales, and the weekly data for same-store retail sales has remained relatively strong, but we should expect to see the consumer slow down over the next several weeks. We should definitely also expect jobless claims to begin to go up over the next several weeks. So the answer is we should see this soon in the incoming data.
Right. So how much can you trust the data that we are getting right now? And maybe trust is not the right word. How much does the data that is coming out, and I think in particular the hard data that shows for the most part things are pretty good, how much does it really reflect conditions on the ground?
Well, that's why a number of the indicators that are already beginning to roll over, heavy truck sales dropped significantly in March. So there was clearly no front loading of purchases of heavy trucks. So this is one way of looking at it and saying, well, you're exactly as you are pointing out, Scarlett, if we still have front loading of purchases across the board, both for capex and consumer spending, we should still see relatively good data. But over time, as prices begin to rise, the consensus estimate, at least from the various quantifications from the Tax Foundation, from the Peterson Institute, also from the Penn Wharton Budget Model and the Yale Budget Lab, is that inflation over the next 12 months will rise by 1 percentage point. And by definition, a trade war is a stagflation shock, meaning higher prices and lower GDP. Yeah. So therefore, the answer to your question is maybe it will take a few more weeks, maybe in the worst case, a month or two, but we will eventually begin to see the net effect if these tariffs stay in place. And that's why we think there's a 90% chance of a recession if these tariffs stay at these current levels.
Having said that, Torsten, the White House is clearly playing a game of chicken with China on tariffs, and also you could say with Jay Powell on cutting interest rates as well. If President Trump pivots in the 11th hour, would it still be possible to avoid recession?
Well, if you exactly think about what are the headwinds to growth, it's just not only tariffs and retaliation, which of course are the most important ones. It's also corporate confidence is very low. The conference board measures and also the CEO index measure from various sources and CFO measures are going lower. CapEx plans are also grinding lower literally for the last 2 months. And of course, consumer confidence is also at the lowest level literally in decades. And the question is, how quickly can corporate confidence turn around? How quickly can consumer confidence turn around? And last but not least, let's not forget that the stock market is down 7 trillion from the peak on February the 19th. This on its own would have been a significant discussion in terms of wealth effects. So combining these things, the trade war, corporate confidence, consumer confidence, the negative wealth effect, it does bring you to the conclusion that this might be harder and harder to turn around, even if there were a pivot, say, coming very soon.
All right, a cocktail of negative drivers then for the economy. Torsten, appreciate your joining us today. Torsten Slok is chief economist over at Apollo Global Management. Coming up, we've seen the NASDAQ sinking lower before some key tech results coming out from Tesla and Alphabet this week. We're going to discuss, get you a preview of the outlook here for those big tech companies next with Sarah Kunst of Cleo Capital. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Klaus Schwab, the 87-year-old founder of the World Economic Forum, which of course hosts its annual gathering in Davos, Switzerland. He is stepping down from the organization's board of directors after 50 plus years. He will be succeeded on an interim basis by the vice chairman of WEF. Next up, we have Cooper Flagg. The Duke freshman and basketball star is now headed to the NBA after leading the Blue Devils to the Final Four. The 18-year-old is the third Duke player to announce an early exit for the NBA in the past week. But Flagg, he is seen as a favorite to be the #1 overall draft pick. And third on the docket is Elon Musk. The Tesla CEO is in focus before the EV maker's earnings tomorrow afternoon. Investors keeping a very close eye on how his political extracurricular activities and the trade war may affect Tesla results. This comes, of course, as the Nasdaq continues to extend its declines, closing the day down about 2.5%. Joining us now to discuss more about the big tech earnings that are coming up this week is Sarah Kunst, Managing Director at Cleo Capital. Sarah, good to speak with you. A lot of people describe today's price action as a sell America trade, and I'm wondering how much is big tech getting caught up in that momentum of this sell America trade?
I think they certainly are, but I think that part of it is a slightly different piece of it. You have names like NVIDIA where they're having a hard time right now. They're likely to have a hard time, in the coming kind of weeks, months as China and the U.S. sort of try to figure out their differences on tariffs. And the reality is, if you've been holding Tesla, I think, or NVIDIA, I think it's still up almost 1,400% over the last 5 years. Like, who doesn't want to lock that in? So I think with some of these tech names, the sell-off is sort of less about the sell America in the moment, although that's certainly happening, and more about, hey, maybe we should call it a win and get some cash on the sidelines.
I like the way you put that. Maybe we should just call it a win and lock in the gains that have been logged over the past X number of years. What would qualify as a win this earnings season from the companies, the big tech companies that will be reporting? Is it something as simple as maintaining their CapEx plans or maintaining their overall forecasts without adding to it or subtracting to it?
I think it's storytelling. I think that storytelling is really where you're going to sort of separate the winners from the losers here. Some companies are just going to be hit hard because of the nature of their business. If they do stuff that just gets a lot of tariffs, it's going to be tough. Even worse, if they get a lot of Chinese tariffs and they have lower margins. That being said, I think what people are looking for in this moment is, do these CEOs have a plan? Do these companies have a plan? You know, my favorite quote of all time is Mike Tyson, right? Everybody has a plan until you're punched in the mouth. Companies have been punched in the mouth. And we saw that with names like United, where they said, look, we're going to give you 2 plans. And we don't know which one is going to work, but we believe that giving you multiple plans helps you have confidence in us. So I think this is very much a sort of confidence game right now, and being able to sell that you understand the moment that you're in and that you are going to be able to rise to meet it for many of these tech companies, more so than just sort of, here's what the numbers say.
Well, speaking of storytelling, what is a story that Alphabet tells about the search monopoly questions hanging over Google? Because this is something that it needs to address, but we also know there won't be a resolution in the short term because this thing could go all the way to the Supreme Court.
I think that there's two separate issues that Alphabet is grappling with right now. One certainly is a monopoly issue. I think a lot of people assumed that a new administration who is uneven but generally less focused on regulatory might sort of let that slide. And who knows, we're probably one Mar-a-Lago dinner between Satya and Trump away from that happening still. But, you know, there was a question of, will that just go away? The answer seems to be right now, no, there will be something that has to be done. And then the other piece of it is, what does Alphabet do when all of their money that funds all of the other cool stuff they do, self-driving cars, AI, all of it, comes from people going to google.com and clicking on those blue monetized links. And when you switch to a more AI-centric ecosystem where people aren't clicking on links in the same way, what happens to their ad revenue? And so I think that the big question over the next couple of years for Alphabet is, do they have an answer for that? Do they have sort of a rabbit to pull out of a hat to replace the ad revenue?
Sarah, very quickly, do you think Elon Musk will give an answer on when he'll come back to the company full time?
Has he ever been there full time? He's always running like 5 companies. I think that you know, everybody in DC seems to want him out. His shareholders seem to understand that it's not working for him to be there. And at the same time, he's not a guy who has to listen to anyone except maybe Trump. And Trump has been relatively coy. So I don't think we'll get a straight answer, because what Elon does best is not give straight answers. He sort of sells some hope and hopes that the markets buy it.
Yeah, so we go back to that storytelling motif then. Sarah Kunst of Cleo Capital, thank you so much. Coming up, we're going to speak to Pollster and communication strategist Frank Luntz. This is The Close. A new week, but some pretty familiar price action across U.S. assets. Big declines in stocks, longer-dated bonds, and the dollar as concerns escalate over the Federal Reserve's future independence. President Trump stepping up his criticism on Fed Chair Jay Powell, reiterating calls for him to cut rates now. Joining us to discuss is Bloomberg's Ed Harrison. Ed, when you look at the price action here, how much of this is a continuation of the pressure we had seen in the last few weeks, and how much of it is new with the president amping up his calls for Jay Powell to cut rates immediately?
I'd say a lot of it is new. The majority of it's new. It's another reason for the Sell America trade, the sense that there's a lot of risk associated with U.S. assets. I mean, if you look at the assets that are most important here, we have the U.S. dollar, we have equities, and we have bonds, all three going down. And when you look at bonds in particular, not only is it that the risk premium is going up, that is the term premium, but also the inflation expectations are going up, because, you know, the potential that there's a less independent Fed means that the Fed could be more dovish, and therefore inflation could be higher going forward.
Yeah, that term premium, of course, is the extra yield that investors demand to own to hold longer dated treasuries over shorter dated treasuries. What will you be watching for tomorrow? Because it's going to be Tuesday, and there tends to be a turnaround on these Tuesdays, but there's going to be a lot more investors coming back to the market with most of the global markets reopening.
Yeah, you know, it's less what's happening tomorrow and more, you know, the earnings call that we get from Tesla, because Tesla's at a level now that it, you know, you could call it a quadruple bottom, where, you know, they've bounced a little bit from the lows. The NASDAQ in general bounced from the lows today. And depending upon how they do and what the reaction is to Tesla, that will give a lot of forward sentiment in terms of the Mag 7 in particular that may leak out into the rest of the equity market. So I'm looking at that in particular for equities, and for bonds. You know, it's just I think that we'll get a reflexive sort of bounce there, and then we'll just have to see what happens in terms of what Trump says, you know, what he does over the coming days.
All right, good stuff. Bloomberg's Ed Harrison, thank you so much, one of our macro newsletter writers here at Bloomberg. Now, for more on the Trump versus Powell showdown, we want to bring in Kailey Leinz, co-host of Bloomberg's Balance of Power. And Kailey, we were talking with Ed about the pressure that President Trump is putting on Jay Powell to cut interest rates immediately, talking about how inflation is basically non-existent when you look at food and energy prices. New reporting over the weekend shows that he's been doing a lot of work in the background to line up a replacement, or to at least think about different ways that he might forcibly remove Jay Powell. What can you tell us?
Yeah, this was confirmed by the National Economic Council Director Kevin Hassett on Friday, Scarlett, who's confirmed that the president is looking into his options to remove Chairman Powell before his term is up in May of 2026. But obviously, there are massive legal questions around that. When Chairman Powell at the Chicago Economic Club last week said that the Fed's independence is a matter of the law, that is quite literally true. The Federal Reserve Act of 1913 does provide protection specifically to members of the Fed's Board of Governors, which cannot be removed by the president except for cause, which legal scholars think about as being largely massive abuses or that kind of thing. Unclear if not cutting interest rates because the president said so would actually fall under the cause category, though I would point out that that applies to Fed governors. And yes, Chairman Powell is one as the chair, but it doesn't necessarily mean that President Trump couldn't remove him of the chair while he remains on the Fed board. So there are a lot of questions around this legally, and ultimately it could be a matter that is decided by the Supreme Court, or Supreme Court decisions that could have implications for independent federal regulators. As we know, they could rule in the coming weeks in the National Labor Relations Board case. Of course, a member of that board was removed by the Trump administration, and it's widely seen as something that could be indicative, if the court were to rule in favor of the administration, as potentially laying the groundwork for the removal of the head of a regulator or a body, an independent body like the Federal Reserve, though it's also possible that the justices would carve out an exemption for the Fed. There's just much that remains uncertain, Scarlett. Of course, at this time, while he's still calling for interest rate cuts, he isn't outright saying he's going to try to fire the chair.
All right, good stuff. Thank you for wrapping that up for us. We also know the president is set to meet major retailers at the White House this week, speaking with executives from Walmart and Target, for instance. Is the idea here that they may get some exemption from tariffs in the same way that countries that go to the U.S. to talk about trade might be able to carve out lower tariffs?
The idea is that they're going to try, Scarlett. Obviously, President Trump has said that he does want to listen to companies and have a certain degree of flexibility around tariffs in specific sectors and what rates are charged. He really talked about this in the context of Apple, for example, and iPhones, but certainly could be an idea applicable to retailers like this as well. We don't know what actually has come out of the meetings at the White House today and whether or not the president will be making any commitments to these companies, but it does show the certain degree of variability around his tariff policies, keeping in mind that he is also watching the health of corporate America and financial markets on occasion, like when he said the bond market was being queasy. And it comes at the same time that, of course, the administration is still trying to work out in this very short 90-day window a series of bilateral trade deals with our various trading partners, prioritizing countries in Asia like Japan and South Korea, but India as well, which is where the Vice President J.D. Vance was today, meeting with the Prime Minister Narendra Modi in the White House, said the two did discuss bilateral trade negotiations, made a certain degree of progress. And so we're tracking stories like that. These countries and these companies all trying to plead their case to the White House, Scarlett.
All right, Kailey, thank you so much. Kailey Leinz is co-host of Bloomberg's Balance of Power, and she will be back at the top of the next hour. Now, for more on President Trump's approval rating amid the tariffs and his pressure campaign on Jay Powell, I want to bring in Frank Luntz. He's a communication strategist and a well-known pollster. Frank, always a pleasure to speak with you. We know President Trump won the 2024 election because he was seen as better than Kamala Harris on managing the economy. So I'm curious, how does the public see his leadership on the economy now?
Well, this is important because I want viewers to understand that among those who voted for Donald Trump, they're going to back him no matter what happens. If the markets go down, they should have gone down. They were too high priced. If countries stop doing business with us, it doesn't matter because we shouldn't be doing business with them. That the Trump voters are willing to justify just about anything that Donald Trump does because they are truly loyalists. And I've never seen anything like this in my political career, that kind of commitment to a president, even in bad times. Now, the reason why his numbers have come down is among independents. These are people who swung to Trump at the last moment because they thought that Harris was incapable of lowering prices, managing the economy, addressing immigration, and otherwise being president. And those are the people who are very concerned about what's happening right now. I'm saying to people that even though the 401ks are being crushed over the last 2 to 3 weeks, that those who voted for him are still behind him, and they will justify just about anything.
Well, we've seen how the White House will blame the Biden White House, for instance, for some of the conditions that led to Trump making changes to trade policy. At what point does the president own the economy? Scott Bessent and Howard Lutnick have suggested that it won't be until the second half of this year. Until then, they state that it is Joe Biden's economy. Is that how the public sees it as well?
In every election up to this point, that was how the public saw it. They would assume that sometime around the 4th of July is about the time that, in normal times, the new president would be held accountable. Not this time. And it's because of this president and how he's approached all these various issues. He floods the zone. That is true. He pushes and prods and is more aggressive than any president that we've seen. It's really since FDR. And so he's going to be held responsible. But they're not. Consumers are not saying that this is a bad thing. And that's something I've never seen before. In the focus groups that we're doing right now, Trump's voters do believe that prices have gone up. They do believe that their 401ks have gone down. But they are not holding the president responsible, at least not yet, because they believe that these are things that have to be done. They should have been done during the Biden administration, and they'll give Donald Trump leeway, at least for now, to keep making decisions that he's making.
Right, and he's alone among Republicans who get that pass from voters because they'll look to other folks maybe in the administration or in the party to put the blame on. Among President Trump's stated reasons for launching this trade war with other countries, not only just even the playing field, but also to bring manufacturing back to the United States. Is this what his voters, is this what Americans want, to bring manufacturing home, to work in factories?
And your point is very insightful. This is not an endorsement of Republicans. It's an endorsement of Donald Trump. This is not an endorsement of an ideology. It's an endorsement of a Trump strategy. And as far as manufacturing is, the biggest complaint they have with China is they don't want our natural minerals. They don't want us to be dependent on any country in general or China in particular. So they are prepared to pay more and suffer a little bit if it means getting off the dependency from the country like China. And that's something we've not seen before. We really are in uncharted territory. And as a pollster, I'm surprised at the intensity, at the passion that Trump voters have expressed in favor of this, even though it's costing them in their wallets and in their pocketbooks.
Is there anything you see that might break the fever then?
Let me answer it this way. At some point, it starts to hurt. At 15%, you can still justify it. At 20%, there is a pain. But let's see if the market continues to go down over the next couple days, because at some point, people really begin to suffer. And I want to make this emphasis. If prices were the number one issue and cost of living, cost of life, mattered so much before the election, make no mistake, it matters just as much right now. And if you have less in your bank account, less in your 401k, and you're getting nervous because you're getting close to retirement, at some point, those people have to break. But I want to emphasize to everyone who's making decisions based on interviews like this, that Donald Trump's support is so strong and so intense that they're prepared to give him a pass for now.
So, Frank, I guess that brings me to my next question. What is it like to poll people right now? A large swath of the public seems to have tuned out of politics completely, avoiding news. Certainly those who didn't support President Trump and voted for Kamala Harris, for instance, or those who may have grown disillusioned. And there's a lot less engagement among that group. Yet those who support him are very engaged. So aren't we getting kind of a one-sided take on what's going on from the people who are willing to talk about this?
Up to a point. First, you've got people deciding, do I buy the refrigerator? Do I buy the car? Do I try to get in and buy the house before prices go up? So those people are paying attention. They may say that it's not politics. They're paying attention to cost of living, but they are paying attention. Second is that in the focus groups that I'm doing, I separate between Trump voters, independents, and frankly, Trump haters. because there are some people who, no matter what Donald Trump does, they will dislike it and they will criticize him. We need to be focused on what happens in 2026 in the off-year election, because should Democrats take either the House or the Senate, everything changes. All bets are off. But I'm trying to understand right now what gives people that sense of fear and anxiety. And there's one other number I'm following, which is whether the country's heading in the right direction or wrong track. And over the last 4 weeks, the wrong track numbers, the percent of Americans who think the economy is getting worse, not getting better, those numbers are increasing. And for the president to look at this, he has to wonder, it's not just about his policies, it's about his communication. Because in general, the public supports getting tough with China. But the way it's being communicated is not effective. And I think that that's contributing to a situation right now.
Frank, always a pleasure speaking with you. Very insightful. Frank Luntz is communication strategist and the nationally recognized pollster. All right, just to recap how we traded on this day, on this Monday, which, by the way, saw fairly light volume because a lot of countries were closed for the Easter holiday. We had a decline of 2.4% for the S&P 500, closing off its lows, but certainly a broad-based retreat that spanned all 11 industry groups, in fact, all 24 industry groups. And we also saw declines of similar magnitudes for the Dow Industrials, the NASDAQ, and the Russell 2000. What we did have was buying of treasuries at the short end. So the yield on the 2-year goes down 3 basis points to 3.76%. There's still a selling of the longer dated treasuries, including the 10-year, whose yield goes up by almost 9 basis points. And the dollar continues to slide, now down 0.7% at 12.16. This is the close on Bloomberg. In the financial markets, the Sell America trade is gathering momentum as Trump's tariffs and pressure on the central bank sends prices lower. Now, Americans are increasingly looking for alternative places to invest their money, to park their money, and some are, in fact, taking a step further by getting another passport as well. Here now to discuss is Armand Arton. He is CEO of Arton Capital. And Armand, just talk to us a little bit here about what you do at Arton Capital, because you are looking for programs, or you help people come up with ways to find alternative sources of residence and passports as well as citizenship.
Thank you for having me, Scarlett. Indeed, for the last 20 years, we help, on one side, governments how to attract these ultra high net worth and high net worth families, because it's a game on. You can see it, even Donald Trump is trying to attract those people with a golden card. Canada has been doing it for 40 years. And when I started 20 years ago, it was the first Hong Kong wealthy family moving out in the 80s and the 90s.
Going to Canada, for instance.
Absolutely. This is where the first passive investment into what we call today a social impact bond. People renounce to the interest in order to get a residency. And over the last 20 years, more than 25 countries have created similar models where you have to make an investment in different assets, bonds, funds, stocks, donations to a sovereign wealth fund, and obtain a citizenship or residency of that country in a more easy and efficient way.
So basically buying their way into another country. What does demand look like right now?
All-time high. So on one side, we have high volatility, geopolitics around the world creating instabilities. You have unprecedented creation of wealth in the last 20 years. So those mix creates a demand for anybody with more than 5 million, regardless if it comes from East going to West, from Middle East going to Europe. You have Americans, Canadians who wants to go to Europe. You have Europeans who wants to come to United States. So it's all directional. Demand is around 25,000 families every year making those investments that starts from $150,000 to $2 million.
Which countries get the most inquiries? Which countries are the most attractive right now?
I would say as a bloc is the European Union. So of course, Southeast Asia, mainland China always like to have access to Europe without visa. Mobility is the number one reason why those families want to be able to apply for those passports or residency.
So it's not just they want to live there, it's they want to be able to travel there or travel under that passport whenever they want.
80% do not actually relocate. They want to have it as an asset. They want to have it as an option B, as a plan. Does not necessarily mean they want to live where they are, where they're making their money and go into another country.
Doesn't this create problems when it comes to taxable income, or at least sorting out your financials?
Not necessarily, because income and taxation is based where you are living and your center of life. So it's not based on the residency or the citizenship you have. Only United States, as you know, charge taxes on your citizenship. That's why you have more than 3,000 families renouncing U.S. citizenship every year. That means they need to obtain another one in order to refuse the American one for tax reasons.
And that's for tax reasons, not necessarily for other reasons like lifestyle or politics. Or
no, you can have two if you want to keep both, but to renounce the U.S. is only tax reasons.
So you mentioned that a lot of people are getting second passports, not so much because they want to live there or move. They want to have that optionality. What about those who are looking to leave their current country right now and actually move to someplace else? That's a brain drain. That's different.
Yes, that is different. It's 25% of the families who are really doing that. Again, it's merely coming from countries where you have a high instability, close to wars and creation of...
For instance?
Taiwan, we have an increased number of families right now who are looking not only to have a plan B, but to really have a second home ready to relocate. Mm-hmm. When the Russian-Ukraine war started, a lot of East European wealthiest families wanted to have assets and families abroad, so they're relocated to the Middle East. So it creates, it really needs a drastic shake of a form of a war or even the pandemic. So this was the first time where Americans realized they could not enter the European Union without visa. Mm-hmm. And that created the first surge of American citizens applying for residency in Europe. In Portugal, that's the country number one that attracted the most American citizens.
So beyond high net worth individuals, if someone is just looking to create optionality for themselves, which country are like their first targets to get a second passport?
So Americans are also looking for what we call citizenship by descent, which does not require any investments. So Italians, Irish, Portuguese and Spanish backgrounds, people who are living in the United States could obtain citizenship based on proving that for second or third generation they have been coming. So this has really gained in popularity because not everybody can afford a few hundreds of thousands of investments.
And that, again, is for the maximum optionality or
Yes.
to live there. What kind of feedback are you getting?
We're getting a mixed feedback. Some are again, when just before the elections, we did a survey, 48% of people said, well, if President Trump wins, we'll leave the country. It doesn't really happen. So it is good to have,
I see.
But it's not a must at this stage, at least not in this country.
Right. You go back to that idea of watch what people do, not what they say.
Absolutely.
All right. Armand Arton, CEO of Arton Capital, thank you so much. Really interesting conversation there about people around the world increasingly looking to get a second passport. All right. Still ahead, what investors need to watch for over the next 24 hours. We've got earnings galore. This is The Close on Bloomberg. All right, let's take a look at what's on the calendar for tomorrow and what we're anticipating over the next 24 hours. And there's a lot of earnings coming out. In the early morning hours before the market opens, General Electric, Northrop Grumman, Lockheed Martin, both of those defense contractors will be reporting along with Verizon. And after the market close, we'll be bringing you Tesla's results along with Capital One and Intuitive Surgical. A lot of question marks with regard to Tesla, which sank in today's trading. Questions about Elon Musk's role with the federal government and when the company is going to actually introduce a lower cost EV as it's promised to do for a while now. And Fed Speak on the calendar too. 1, 2, 3, 4, 5 Fed speakers tomorrow. Jefferson, Harker, Kashkari, Barkin, and Kugler. Some of these will be in introductory remarks. Some of them are fireside chats. Of course, there's a lot of debate here over what's going to happen at the Federal Reserve given President Trump's pressure campaign on Jay Powell to cut interest rates. And the IMF and World Bank spring meetings continue. Team Surveillance will be all over it. They will be hosting the program out of Washington, D.C. Lisa Bromwitz will be on the scene, and the IMF will be issuing its World Economic Outlook. They will have all of that coverage for you. In the meantime, just a reminder here that we finished the day off with declines in equities, with the S&P 500 losing 2.4% and yields moving higher at the long end of the yield curve and the dollar under pressure. This is The Close.